Hello, everyone. This is the Free American Press with your host, Alexander Horat. Today, we're going to be having a very special guest on the show, and his name is Andy Schectman. He's the president of Miles Franklin. Hello, Andy. Thank you for being on the show.
Alex, my man, good to see you, buddy. Been too long. Nice to see you again. Look forward to seeing you in Dallas in a few weeks. Good to be back with you here today.
Yeah, I'm really excited for that. And for everybody who doesn't know, the Economic Ninja is going to be holding a conference with Andy and some other people in March, so in Dallas. So if anybody wants to go to that, check out the Economic Ninja's page and you'll be able to see what's going on. So I'm going to be sharing the screen, Andy, because we're seeing that right now that gold is actually reaching all-time highs. Recently it's touched $1,900. So I just want to get your thoughts on this. And yeah.
Well, I think that gold is certainly reacting to the volatility that we're seeing, no question about it. I think that when you take a look at, from a technical standpoint, we see a rising wedge pattern. It's a very bullish, not only is there a cup and handle pattern on gold over the last year or so, we also have a rising wedge pattern. Without getting too deep into the technical side of things, what it typically signals is a breakout one way or the other, and it's broken above its 50-day moving average and is rapidly approaching, if not already breaking through its 200-day moving average. I think that people are waking up to what is a growing awareness that inflation is eating away at the value of our dollar, and at the same time, the inflated asset prices would be the first thing to be corrected if the Fed holds true to its promises to fight inflation. And I think that there's a high probability that they will until the markets start to crumble. The question is, what do they do then? Do they come back in and rescue, or do they really actually try and get tough on inflation? And that's really the question. Hold on. Sorry about that. I have my ringer on. So anyways, yeah, what we're looking at is a situation where the Fed has painted themselves into a corner. And as a result, I think you're beginning to see gold and silver react to that. Of course, what's going on in Russia and the Ukraine is certainly an accelerant to that. But as far as I'm concerned, that isn't the main reason that gold should be doing what it is doing. It is the outright destruction of the value of currencies globally that has driven people across the globe to run to one of the few asset classes that are not completely distorted in terms of their price valuation or their price discovery. One could argue that the distortion in terms of price discovery in metals is that they've been suppressed, whereas the distortion in price discovery in most other asset classes is that they have been pumped to levels that are unrealistic, unjustifiable, and unsustainable at the same time.
Yeah, I definitely agree with you. The whole Russia thing, they're saying that's why gold has been going up. And I think you're right. I don't think that's really the reason. I think it's inflation, like you're saying, and everything else that's been going on recently. Yeah, so we definitely see that gold is moving. So you say that this could be gold's breakout. So if this is gold's breakout moment, how high do you think gold will go in, let's say, the next 3 weeks or so?
Alex, I think it's very difficult to make those types of statements. But look, we're seeing a lot of mainstream, mostly commercial banks, which typically I would say don't listen to what they say because they're the root of the manipulation. But 2,500 to 3,000 is what you're seeing by, for example, Bank of America and many of the other analysts who I think are looking at the reality that governments since the beginning of time have chosen inflation over austerity, and that probability of gold being much higher, I think, is certainly, especially looking at the technical charts, looking at the pickle that the Fed is in. I think prices will go higher than people think possible. Now, when we say over the next few weeks, that's debatable. look, you got midterms coming up, and you have a dilemma. I think inflation is starting to drag down President Biden's approval rating to the lowest level it's ever been. And I think that there is a tough decision that needs to be made. I think you will see great volatility. I think you'll see 7 or 8 rate hikes over the next year or two. And if they were really serious about getting tough on inflation, we'd see a 50 basis point rate hike and immediately start selling off of their balance sheet like they've been talking about. They're still quantitatively easing. They're still buying assets. They have to stop that. Not only stop it completely, they have to sell it off their balance sheet as they're proposing to do in March. When that moment happens, you see great volatility in markets that have become addicted to stimulus and easy money. And, I think that's what it's going to take to wake up the public, this volatility. Look, you have a younger generation that doesn't want to work. Many of them are Bitcoin millionaires. You have an older generation who's watched their asset prices go to the moon. They want to retire. So we have a labor participation shortage. At the same time, we have low unemployment, but we have horrible labor participation. And so I think that this is a problem. You have a lot of people not producing anything with more money than they've ever had. This is creating price inflation. And I think what you need to do is create volatility into the markets. And this is what Zoltan Pozsar was talking about in his latest article. He's the repo market guru, that the Fed is caught in a pickle. And either they're damned if they do and they're damned if they don't. And the way that his proposal is suggesting is that the only way to bring down inflation is by curbing demand. And the only way that you can curb demand is to have what he called a Volcker moment, or create a good deal of volatility to scare the markets, to drive down prices, to make people not so eager to go out and spend, and that will bring down asset prices. This is something that the Fed has never been able to do. This article will talk about they want to quantitatively tighten. They want to slow things down without creating a recession. This is something that they won't be able to do. And the gist of it is that, as this article mentions, that the terminal rate, as they call it, or what is neutral rates for the markets, will likely be well below the neutral rate for the economy. And so, in other words, in order to slow down the overheating economy, they have to raise rates. But by doing that, you blow up the markets. And so I think that what he's basically saying is that if you don't crash the markets, you won't shock people into perhaps getting back into the labor force, perhaps not being as eager to spend and purchase and accumulate, which will slow the economy, but also slow inflation. And it's really walking a tightrope, Alex. It's something that not really has never been tried before. And, you have a very non-committal FOMC that they don't know what they're going to do in March. I don't think they know what they're going to do, because they've really painted themselves into a pretty dark corner where one way or the other, a pound of flesh is coming, and whether it comes from the markets, including Bitcoin and cryptocurrencies, which have created this wealth effect and making people not work, making price inflation much more magnified. Either you crash the markets or you don't, and you sacrifice the dollar, and you sacrifice, obviously, the whole Democratic Party if you see inflation run rapidly out of control, even more than it is right now at 40-year highs, and grossly understated from the 15% that it really is to about 7.5% that they're calling it on this latest CPI. So when you see the federal funds rate at 0 and inflation at 7.5%, grossly understated. Excludes food and energy and housing, the 3 areas that are maybe most inflated next to used cars.
So
you got a problem.
So if the Federal Reserve does decide to crash the market, what are some warning signs for everyone that we can watch for if that's what they plan on doing, and then they start to do that? Like
an immediate 50 basis point rate hike in March, and immediately stopping. As soon as they stop asset purchases, in fact, start to unwind their balance sheet. I'll give you an example. One of the things that Powell said, Fed Chairman Powell, was that he only wants to see US Treasuries on the balance sheet. They have $2.9 trillion in mortgage-backed securities on the balance sheet. We've seen interest rates rise by 40 or 50 basis points since they started talking about this, which has already translated into a 10% reduction in new home applications. And so when you see a slowdown, which we're beginning to already see in the economy, no one's buying cars because they're too expensive. People are spending less on things that aren't necessary because they cost more. The things that are necessary cost more, and it's putting a crimp on discretionary spending. And so what we're seeing is a slowing of the economy. And what is dangerous is a tightening policy into a slowing economy, which could really start to exacerbate that deflationary, recessionary, borderline depression type of move. And so what you will see will be a Fed that comes in, if we see a Fed that says we're going to raise rates by 50 basis points. If they start to raise rates intra-meeting, which has been discussed, and if they actually start to sell off their balance sheet, first they have to stop buying assets, which they said they were going to do sometime probably in March, stop buying assets, which is quantitative easing, and transition to quantitative tightening, which is selling off assets. And you dump and by the way, they said they want to do this in a more expedient fashion than they have before. So you start to rapidly dump 50 or $100 billion a month in mortgage-backed securities on top of a slowing housing market, you'll begin to see real problems with housing market. And they say that in every 1% increase in interest rates translates into roughly a 10% decrease in house prices. So you have issues at hand: a crashing home market, a crashing stock market. This is the wealth effect. This is what the Fed has done so much to build and foster, is this wealth effect. And so as a result, they've painted themselves into a corner, because if they raise rates and if they start to dump mortgage-backed securities, if they start to sell off some of their treasuries, and we see rates rise, we see the housing market fall, we see the stock market correct due to the rising rates and the implication of what future will come, all of a sudden people don't feel rich anymore. All of a sudden that discretionary spending stops. All of a sudden people start to save. All of a sudden people are more concerned about getting back into the labor force, which will produce more goods, which will help to ease the price inflation, because as it is now, we have fewer people producing stuff, more people with money looking to buy stuff. You have less stuff and more money in search of stuff, prices go up. So this is a real tightrope that they're trying to walk without busting everything wide open, and while pretending to get tough on inflation. It's not an enviable position.
And you were saying if they tighten the market, we're going to see, real estate crash and a lot of other things crash. So most likely wages would also crash as well, right?
That's one of the things I think that they're looking to do something with. And the way that happens is by crashing the market. Corporations start to lay off. They're not as eager to offer higher wages and incentives to get people to work. It's all of a reinforcing loop. People feel rich, they've been given money, they've made money in their equities, they don't need to work. Companies have no one is filing for unemployment, but no one's working, so the labor participation rate is poor. And the way that the unemployment rates work is that, or the unemployment rates measured by the Bureau of Labor Statistics, is after you fall off, you're just off, you're gone. And so a lot of these people who are just not working, they're not even listed as unemployed. But when you look at the labor participation rate, it's at all-time lows. So you need to get people back into the workforce to produce more stuff to get an equilibrium. But I really think that they have to raise rates enough and get tough enough on inflation to bring equity prices and asset prices down to a level that is more commensurate with reality. And the problem is you have the rates being set by the Fed and the bankers and not by the market itself. And this is creating and has created massive distortions that they have to deal with right now because inflation just keeps on rising. And when you look at the supply chain bottlenecks and less people producing things, I don't see this going away for a while. I think this is here to stay for the foreseeable future. And if they don't do something about it now, it's only going to get worse. And so I think they'll walk the tightrope of really shaking the markets, all of them. And if they don't, their credibility is at stake. You know, they say they're going to do this. If they don't, the Fed will be rendered neutered. And that's when the market takes over itself. When the bond market senses the Fed is out of choices, the bond market will run. They will flee, and you'll see interest rates spike and the dollar dump. And that's when things get really, really, really frightening, I guess you could say, a religious experience.
Yeah, so it seems like if they tighten the market, like it seems they may be, it seems like almost everything will go down. Do you think there's going to be anything that goes up or remains stable during an event like this?
Well, the only inversely correlated asset class to the US stock market are precious metals. And when you look at asset classes at all-time highs and then look at silver and gold, I mean, yeah, gold is still $200 or so from its all-time high, 10, 15%. Silver is half of it. Just about everything else on the planet is at all-time highs factored against the lowest interest rates in human history. And, you know, there's a term in economics, Alex, called Gibson's paradox that measures the inverse relationship between real interest rates, not nominal, real, and gold. And when you look at the Fed saying they want to raise rates to 2%, that's spitting in the ocean. It does no good. It's not going to hurt gold. In other words, even though gold is inversely correlated to a rise in interest rates, when you have inflation at 7.5% and the yield on the 10-year Treasury at 1.8% and the federal funds rate at 0, the only way that you can combat inflation is to where economics called the rule of 70 seconds, Alex, which you take the interest rate and divide it into 72, and it tells you how long before your principal doubles. Well, at 18% interest rates in 4 years, your principal doubles. So who wouldn't buy US Treasuries at 18%, where you put $1 million in, and in 4 years, by the time your kid's done graduating high school, you got $1 million profit to put into his college education or hers. Point of it is that you, in order to do that, raise rates to that level, you know, we didn't back then, you didn't have markets at all-time highs and distorted through years of Fed intervention and manipulation. And so in order to really get tough on inflation, you have to raise the federal funds rate, which is at 0, above the rate of inflation, which is 7.5% right now. You'd have to raise interest rates 800 basis points. A basis point is 1% of 1%. So 8 full percent, you'd have to raise it just to get above the rate of inflation, which is understated, which excludes food, energy, and housing. But taking the number as it is, in order to get ahead, which is the real rate. So if you take 1.8% or 1.9% on the 10-year Treasury, that's what you're paid for investing in the Treasuries, but you are fighting a 7.5% inflation. So you're negative, real terms, over 5%, almost 6%, real negative. And in order to stop inflation, you have to raise rates above rates above the real rate. The real rate has to be positive and has to be above the rate of inflation. We're a long, long, long way away from that. So what they were talking about earlier when I was saying that the rate for the economy is different from the market. In other words, what they're saying is that in order to remove the inflationary overheating of the economy, stocks will crash long before you reach that point. And so you have a crashing of stocks and bonds and real estate long before you ever reach that point where you correct the economy, you correct the dollar. You have to remove the excesses in the market. And I don't see that happening, but what I do see is them raising it enough to really shock the market. And if they're really serious and they're talking about this reset, well, here's your chance to do it. Raise rates way the hell up there and blow everything up and start from 0. And that's pretty much what would happen. You'd see the biggest depression of all time. You'd see the S&P fall by 50% in a day. I mean, it would collapse.
So how long do you think, if they do decide to do that policy, make a money type policy, a lot of people are wondering if they do that, how long do you think that period would last of them keeping money tight like that until they start inflating again?
Depends how serious they are about it, how much pain they're willing to go through. They should have done this in 2008. We'd be long on our way to recovery. But if you look at 2008 as the beginning point, which is probably not a good beginning point, but look at it. In 2008, they had 800 billion on their balance sheet. The Fed did. Now they have almost 9 trillion. They would have to unwind all of this. So you have 12 years, 13 years worth of excess built into a system. And if you bad enough stop blowing air into the blue and you start to prick a hole in it and selling off your balance sheet, stop accommodating the market, stop giving the stimulus, keep raising rates, making it less equitable for speculation. It could happen a lot faster than people think.
Do you think if they do this type money thing, do you think food prices will go down as well with real estate, or do you think food prices will kind of stay the same?
I think it will take some time for all of these inequities to right themselves. You have so much in the way of intervention into the markets that have created all of these distortions and the bottlenecks. I don't think anything's going to happen overnight. I think the markets will, and that's what he's talking about. The markets will collapse before the economy rights itself. And so, you know, in order to get the economy right, you have to get inflation and interest rates closer together. And until that happens, get people back into the labor participation force, get rid of these impediments to capitalism. You know, we're a country that's embracing socialistic policy and vilifying what made this country great, capitalism. And we need to get people back into the workforce. We need to get a semblance of reality in the equity prices. In other words, before you see that kind of a equilibrium, a fair price for a box of strawberries and a couple of steaks, we need to see the markets collapse. And that's what they're saying here, is that you can't get the market or the economy where it needs to be before the markets puke. And I think that's the real issue, Alex. And that's one that people need to brace for. And that's why sitting in these markets, cryptocurrencies, equities, bonds at all-time highs with all of this risk and the Fed painted into a corner is very, very risky at this point. And I think you'll see the markets puke long before we see a semblance of equilibrium in the economy for things like food prices and energy prices and all of these things that are so important. I think it's going to take some time.
And we'll probably see a lot of banks collapse too, right? If this happens, and possibly people not able to get their money out.
Absolutely. Alex, I need you to hold on 1 second. Can you stop it and then re-record in a moment? Hang on 1 second. Sorry about that, Alex. I had to jump off there for a second, had to put out a fire. In any case, yeah, look, the bottom line with all of this, Alex, is that the Fed is painted into a corner and there are very few ways out. And now they're exploring more creative ways to shock the system. I guess we'll see how much resolve they have and to what lengths maybe this is the beginning of the Great Reset. Who knows? I don't know. But when you see margin debt at all-time highs, valuations at all-time highs, when you see the stock market at 210% of GDP, that's almost 70% higher than the long-term trend. When you see these excesses, they have to be canceled out. They should have been a long time ago, and it's pretty much put up or shut up time for the Fed. And I think we're going to begin to see that very soon. So I really do believe that gold has broken out. I guess we'll see if it has the staying power. I think in order for it to really be confirmed, we need to see silver join the party and get above $25. So as we are doing this right now, I believe that, let's see what silver is doing here today. Silver is at $24 or just under. So Gold at 1900, silver almost at 24, both up over 1% today. Is this the beginning? I guess we'll see. But needless to say, this is, I think, the market's way of reacting to all of this volatility and all of this uncertainty, heading into what ought to be one very, very interesting spring, I guess we could say.
Yeah, I definitely agree with you there, Andy. And for the viewers, do you have a special on gold or silver this week?
Yeah, we have some 10-ounce silver bars that we're offering right now at $2.95 over the price of silver. And we have 1-ounce silver buffalo rounds at $3.15 over the price of silver, excuse me, $3.19 over the price of silver. But, you know, like I've always said, I really am eager to work with your listeners. I get a lot of people who mention to me they like the fact that you and I talk together. They think that you're a heck of a young man for doing what you're doing at such a young age. And so that's why I want to personally give out my email at Andy@MilesFranklin. And whether it be the specials that we have in 10-ounce bars or 1-ounce rounds, or anything that your listeners are looking for in precious metals, gold, silver, platinum, palladium, numismatics, you name it, I will personally answer everyone's question on your behalf, make sure they get the best price in the country. And for everyone out there, a good portion of all of the profit that is generated from any sales will be given back to Alex and his endeavors to further educating the young people of this country who I think need it, at least in terms of understanding where we are in this cycle. And the only way that you win as a young person is to start paying yourself first, start accumulating gold and silver, accumulating savings, and always pay yourself first. Every single paycheck, take a portion of that money and take it right out and put it into something that will build assets and build wealth for you. And that's one of the things I admire about you. You get it. We've been talking, I don't know if you're 18 yet, but I know you're 17 when we started, or were. Are you 18 yet, by the way?
Oh, yes, I am.
Well, happy belated birthday. There you go. I mean, you know, there are very few people who at 17 and 18 understood with such depth the way that you do what's going on. And I'm very happy to be a part of what you're doing, and can't wait to shake your hand and see you in person in a couple of weeks in Dallas. But in the meantime, Andy@MilesFranklin, special or no special, your listeners will get the best price in the country. And I personally will answer their questions and follow back up with them to make purchasing precious metals, which I want people to know is wealth, not an investment, make it a good experience.
Yeah, I definitely agree with you, Andy. And please write Andy@MilesFranklin and mention the Free American Press if you'd like to get precious metals. And I would like to say thank you for everyone who's been watching the show. And I hope you all have a good day. God bless.
And one last thing, Alex, make sure you bring your camera with you to the show in Dallas. We'll record one of these live, and that ought to be fun. Maybe we get the ninja to do it with us as well.
Yep, I definitely will. And
right.
and I'll see everyone who comes to the conference too. And you all have a good day.
See you next week. I'll see you next week here, and the week after in Dallas. And in the meantime, you take care of yourself. Thanks for having me.
Sounds good. Thank you, everyone. Goodbye.